The dollar is up, and that is causing all kinds of problems in the emerging markets. In the crypto market, we're seeing a correction, strike against technology, growth, innovation. We believe that COVID-19, the coronavirus crisis, accelerated the shift towards the innovation platforms around which we have based all of our research. And I'm going to give you a few examples of that in a minute. I do want you to know that, of course, we've been through a very difficult time since the significant rotation from growth into value started nearly a year ago in mid-February. And I want you to know that we're in there with you. We think that that is a vestige of the tech and telecom bubble and bust. A lot of strategies started moving towards benchmark sensitivity because of the tech and telecom bubble and bust. And they really stopped focusing on true innovation, transformative innovation, disruptive innovation. The gleam in the eye, the dream during the tech and telecom bubble, investors were falling all over themselves to get the next deal and to ride it up hundreds of percent within a few days. And of course, that was not real. I'm going to read you some of the companies that went poof from that time. These were the largest .com busts: Pets.com, Webvan, eToys, GeoCities, theglobe.com, Go.com, Flues.com, Docoop.com, and Cosman.com. Many of these were out of business within a few years because they were being priced on nothing but eyeballs, not just current eyeballs. Dr. Coop, for example, averaged 1.4 million monthly average users, or the equivalent thereof, and it went public in June of '99 and was out of business in December of '01 because the valuations that people chased were simply based on eyeballs that might materialize and never did materialize. We are nowhere near that situation now. The dreams back then for the internet was quite transformative and led to the cloud and artificial intelligence. We are living in the reality that dream started. And this reality has companies like Teladoc and Zoom, just to give you a sense of the contrast here. You know, Teladoc has about $2 billion in sales. Its revenues have gone up fourfold since the beginning of the coronavirus. And we don't think that its revenues are going to go down. What we're seeing in the market is a focus on year-over-year momentum. And the comparison that we're going to see, and this is the last of the really tough comparisons, the significant percentage of my total net worth, we're all in. And my conviction couldn't be higher that the innovation that has been evolving and was accelerated coming out of the coronavirus crisis is unstoppable. And the convergence between and among the 14 different technologies that we are researching, that convergence is underway now and is causing and will continue to cause explosive growth, really the likes of which we haven't seen in our lifetimes. And when I say explosive growth, I mean when it comes to those innovation platforms. They're going to cause a lot of problems for the underlying economy, the traditional world order. And I'll explain a little bit more about that in a moment. So let's start with monetary policy. What has riled the market in the last week or so is Fed minutes being released suggesting that the Fed is going to become more aggressive at raising interest rates, perhaps sooner than many expected, maybe in the March timeframe. Now, what we believe has happened here is that the Fed, having suggested that inflation was transitory since the beginning of the coronavirus, was becoming concerned when it saw CPI inflation, headline inflation, year over year at 6.8%. And it does not want to be blamed for inflation being sustained and certainly not moving out of control. We think this is a bit of jawboning here. We think that some of of the economic statistics that I'm going to share with you in a bit, the Fed knows very well. And those statistics suggest that inflation is indeed transitory. But on the off chance, and I'm sure there's a big debate going on at the Fed, there are going to be some Fed governors and Fed presidents who are looking at statistics and are citing some that are still on their way up. There are others who are going to be citing statistics that are on their way down, but they want to err on the side of hawkishness or being too tight right now, certainly from a jawboning point of view, because they don't want inflation to continue to escalate. The dollar is up, and that is causing all kinds of problems in the emerging markets. The Turkish lira, as I mentioned on our last video, the Turkish people have lost half of their purchasing power in 1 year relative to the dollar. That's the Turkish lira. It's gone from 7 to about 14. It was as high as 18, nearly 20. And I think it's going to go back there because their foreign exchange reserves were cut in half the last month to something like $6 billion. $6 billion is nothing to withstand the onslaught of the currency speculators. We're also seeing Kazakhstan, the protests there, shutting down the country's internet. I know Russian forces are in there. I think we're going to see a lot of more hotspots in emerging markets. And the dollar going up suggests a flight to safety, and that is a downward force on inflation. Commodities are priced in dollars. The dollar's going up. All other things equal, commodity prices would go down. In the crypto market, we're seeing a correction. They are starting to succumb to what we're seeing in the equity market, which is this strike against technology, growth, innovation. We think that's going to be short-lived. And I'd like to end right now by talking through just one more thing and giving you a sense of where the bubble might be in this market. It is not in innovation stocks. They've been cut in half, many of them, some by 75%. The homeowner had to decide, okay, I can't pay everything. I'm out of work. What do I pay to just keep things going? Well, they were going to pay their auto loan down and default on their mortgage because it would take a while for them to get kicked out of their house, but they needed to get to their jobs. Today that would change because of ride hailing. So we think that complacency is misplaced and that the auto credits out there could become a mess. So if I'm right on any of this, there will be disappointments in terms of the auto sector. And I wouldn't be surprised if at least one of the companies loses money next year, which would be most unexpected. And if it loses money, what is that valuation? Where are the crazy valuations now? Are they in our stocks now that Zoom is down to 33 or 35 times this year's earnings? Or is it in an auto stock where there might be losses? And what's that PE ratio? That's infinity. That's where the bubble is. And I think you're going to see a lot more cases in point as this year moves along and the innovation that we see evolving so rapidly. DNA sequencing, transforming healthcare, robotics, solving the labor shortage problem we're having, energy storage, the consumer preference towards electric, artificial intelligence, which is the glue that is helping all of these technologies converge. And the last one, blockchain technology. We think that we're in a period of innovation that was the dream in the late 90s. But those companies were vaporware. They were based on nothing but eyeballs. We have real revenues. We have incredible growth rates. And if we're right and the economy has an inventory problem, then our growth rates are going to look far superior anything you'd find in the value space. And we are really looking forward to that.